Our next guest is the winner of this year's Australian Hedge Fund of the Year. He is, in fact, the only manager who had a positive return in every month of 2008, according to Australian Fund Monitors, which tracks the performance of more than 200 hedge funds managed from within the country. His funds have exposure both to the Aussie and US dollars. John Corr, founder and managing director of Fortitude Capital. He joins us from Sydney this morning. John, good day, and of course, congratulations.
And good morning.
First off, John, you thrive on volatility. Would you agree that stability seems to have returned to the market right now?
Oh, it certainly has, and we've seen obviously a marked decrease in implied volatilities across the market and much stabler markets, particularly in equities. We think less so in some of the other asset classes that we watch, but there certainly seems to have been a lot of capital put to work in the equity markets, and that's stabilised prices. Obviously seen dramatic price increases, and in that environment you generally expect to see decreased volatility.
So how are you positioning yourself? Any different from 6 or 12 months ago?
Yeah, certainly 6 months ago we took a view to take a lot less protection, to own less volatility. Our funds are mandated to own volatility, so we always buy more option premium than we sell. So we always have protection in place. There was a number of signals through the markets, we think early or late in the first quarter this year, that intimated to us that there was dramatic amounts of capital being put to work. So we took a lot less protection and took on a fair amount of risk for our portfolios. We saw that increase, and the extent of the rise in the second quarter this year took us by surprise, and we've run fairly strong protection since then, which obviously has not paid off, but has protected us from any surprises on the downside. And you know, the nature of our funds is that we don't want surprises on the downside.
Your Fortitude Capital's Absolute Return Trust invests only in Australian equities. Where are the opportunities right now, given that the benchmark has rallied almost 50% since it hit bottom back in March?
Yeah, we think that we're still seeing good opportunities in hybrids and in the M&A markets. And so in takeover situations, we're still seeing some quite attractive returns. So we're concentrating a lot of our portfolio there. We are also looking at a couple of concentrated hybrid positions that have fairly short maturities that we think are providing some very attractive risk-return profiles. We're probably avoiding a lot of strong exposure to the equity market. As I said, we took a lot of that risk off at the end of second quarter, and you know, we're not really exposing ourselves to any particular sector. We think the Australia is heavily concentrated in both resources and banking, and both of those have had dramatic performances. So if anything, we're running relatively neutral positions there with some good downside protection.
In terms of specifics, you like the usual favourites, Wesfarmers for one. Its full year profit missed estimates. Will it be different in the coming quarters?
Well, we try not to make forecasts. We don't rely on forecasts a lot. We think a lot of effort goes into making forecasts that generally turn out to be inaccurate. We think Wesfarmers definitely has potential to miss on the downside quite dramatically. It's shown that propensity in the past, and more recently to a very large extent. We are running a position there that is quite heavily protected to the downside, but we do have big exposure to the name.
When you take a look at Wesfarmers, go ahead.
Yep, sorry, you're right. We'd probably have a larger exposure to the upside in Telstra. That's one where we think the recent activity by large shareholders and by statements by the government probably have seen the bottom in the name, and we are trying to position our portfolio to have stronger upside exposure there.
We know that Wesfarmers has businesses ranging from mining to insurance. Will it be better for shareholders if it breaks up those businesses into separate companies to release capital? Will that make sense?
I think it will in the short term. I think the conglomerate model is probably not particularly strong in this type of environment, and people are looking for more specific earning streams and want to buy specific earning streams. But I mean, this is part of the cycle. We see conglomerates form during strong markets, and generally are de-emerge during weaker markets. Although we've had a rally, I think the pressure will be on management to really prove that it can make it work as a whole, rather than investors who are probably looking to see individual exposures to cash flows from the specific industries.
Okay, John, sit tight. More with John Corr of Fortitude Capital very soon. Now, we've been stock picking with John Corr, founder and managing director of Fortitude Capital. He was named winner of Australian Hedge Fund of the Year for 2009. John, looking at stock picks, Lion Nathan, your biggest exposure, up 45% year to date. How much will it get a boost after shareholders voted in favour of the Kirin acquisition?
It won't have much more of a boost, because it actually will delist late this month, early next month. So it's still got about a 0.5% to 0.6% yield that will play out over the next few weeks. So I mean, I think the impact there will be obviously potential cash flowing into the other consumer areas, and we're seeing some impacts of that, particularly in Foster's.
In terms of earnings for this particular company, how confident are you about it after 3 years of stalled profit?
Well, because Lion Nathan's under takeover, we're not, earnings from here is not really the responsibility or the care of current shareholders. They've sold the company to Kirin. So it's all about what yield we can get and where we can buy shares or offload shares over the next couple of weeks and take advantage of what we see as an arbitrage profit.
Okay, one stock I'd also like to look at is Macquarie Airports. You're liking Macquarie Airports, don't you? I mean, it's seeking to take control of its own management. A good move?
Yes, we think so. I think this alignment with Macquarie Bank is obviously going to be a positive. We've seen some reaction from shareholders to the events of last year and the fees that were flowing through to Macquarie Bank, and most shareholders believe that Macquarie Airports and those subsidiaries of Macquarie will be much better and have interests much more aligned with shareholders rather than the parent company.
Do you see the company in any M&A activity or in any expansion plans in the next 6 to 12 months? I mean, this is one company which owns assets from Sydney to Brussels.
Yes, I think probably the activity we saw in Macquarie Communications earlier in the year suggests that pension funds and superannuation funds around the world will probably like the cash flow from these assets, from infrastructure assets, and we think that there's likelihood that they may be the natural owners of these assets rather than even having another layer of management in between. So it certainly wouldn't surprise to see that develop.
John, let's talk about your fund. You've launched your new equity income fund this month. What's the selling point for this particular fund?
This fund is looking at the moment, is looking for local investors that want to be in the equity market and take advantage of the capital appreciation that is expected from equities over time, as well as the tax advantages for dividends and capital gains in equities in Australia. What we're trying to do is provide that index-like exposure with lower volatility using an income writing strategy to increase the yield, but also to decrease volatility. One of the roles we'd like to play in the asset market in Australia is to be a provider of lower volatility returns.
For those who have missed out on the rally that we've seen so far, is it too late to catch up?
Good question. We think that for these type of investors, this fund will concentrate in the top 15 to 20 names in Australia, and we think it certainly could have been better timed, but this is a long-term strategy that will look to take advantage over a number of years. So we think it's quite opportune. You may well have missed the bottom, but this is a safe way to play it, and will protect you on the downside if there is a further pullback in markets.
John Corr, founder and managing director of Fortitude Capital, thank you so much for being on The Trade today.